In a widely expected move, the Bank of Canada held its key interest rate steady at 2.75%, where it's been for 3 consecutive meetings. Joining me now to discuss is James Marple, Associate Vice President and Senior Economist at TD. James, thanks you for joining us. And there wasn't a lot of uncertainty coming into this meeting on whether we'd get a rate cut or not. So what was it that led the Bank of Canada to hold?
Well, the economic data really has come in relatively resilient. We had a pretty strong job report in the last monthly report. The unemployment rate ticked down a little bit. And then on the inflation side, we see still some inflationary pressures. If you take out the reduction in the carbon tax, which brought the headline down to 2%, ex-taxes were still around the 2.7% mark, and that's a little bit higher than they'd like it to be. They note that there are signs of inflation decelerating, but a lot of uncertainty on that front just related to tariffs and the pass-through of tariffs and even just production costs to consumers over time. So I think really the underlying resilience in the economy and the fact that they have cut a fair amount prior to this situation, and they're pretty close to what they think the neutral rate is, means that they really would have to see more economic deterioration before they cut further.
Okay, so given that viewpoint, how are money markets pricing in further moves in the Bank of Canada's overnight rate?
Well, there is one more rate cut priced before the end of this year, which would bring it down to 2.5, which is basically their neutral rate. That makes some sense. I think we could see, again, in the economic data, we will see, and in fact, this was the Bank of Canada's forecast, that the second quarter will show negative GDP growth. And to the extent that that weakness, especially in the export sector, bleeds into the second half of the year, I think we could even get 2 rate cuts before the end of this year.
Okay, so I think the big uncertainty right now remains tariffs and that August 1st deadline. What happens if we don't reach a deal, and what are the implications for monetary policy going forward?
Sure. Well, the Bank of Canada actually in their monetary policy report sort of laid out various scenarios for tariffs, and in their so-called, they don't call it a baseline scenario, but they call it current tariff scenario, which is leaving things basically where they are, which is, we have the 50% tariffs on steel and aluminum, we have the 25% tariffs on autos with some carve-outs for U.S. parts. And if you leave that in place, we get a modest rebound in economic growth of about 1%. If tariffs are escalated, obviously we're going to see probably a worse outcome than that. The Bank of Canada themselves say they think economic activity could contract through the second half of the year. And I got to say that makes a lot of sense. If we were to say tariffs rising from the current rate, where, this, I should mention, the USMCA carve-out is really been important for Canada. I think that has contributed to some of the resilience relative to this, the first announcement that everything was going to be hit by very high tariff rates. If we're in that kind of world, then obviously we're looking at a much worse decline in Canadian economic activity just due to our direct exposure to the U.S. But, I think there's a good chance that remains in place, and as long as the tariff rate, even if it doesn't get a lot better from here, if it remains in place, at least having some certainty around it, we've made a lot of the adjustment already, exports have declined, then I think we could be in for at least a modest rebound. If it escalates, things are going to deteriorate.
Okay, one of the things I want to talk about is the Canadian dollar, because it's actually remained relatively stable against the U.S. dollar so far this year. But given this latest decision, how do you expect the loonie to perform going forward?
Well, a lot of that will depend on the U.S. economic performance and also the decisions of its central bank. And we have seen that some of that U.S. exceptionalism that was driving the dollar higher over the last few years has kind of come into question. And the U.S. is not only in a trade conflict or putting tariffs on Canada, they're putting them on the entire world. So we're likely in a situation where U.S. growth is going to slow over the remainder of this year. We already have seen signs of that. Had a pretty good rebound in the second quarter, but definitely not the rate of growth that it was, and its outperformance has come into question. So I think that, and the fact that the Federal Reserve is likely to start cutting interest rates later this year, probably not at this meeting today, but later on in the year. And that differential, we think the Fed will cut more than the Bank of Canada, which of course has already been cutting, and that will give a little bit of upward pressure on the loonie relative to the U.S. dollar. Not a lot, probably pretty close to where we are, but we think 74 cents by the end of this year.
Okay, so looking ahead, What are some of the indicators you'll be watching closely as the Bank of Canada considers its next move?
Well, certainly the job market, the labor market, and whether there are signs that we've seen already job losses in sectors directly exposed to trade. Obviously, if that worsens, but even if it starts to bleed into other sectors of the economy that are not directly impacted but indirectly impacted, obviously that's something that would be a pretty dovish signal and say maybe there needs to be more support for demand in the Canadian economy. On the other hand, I'll also be watching the inflation data. If the inflation continues to soften, we've seen shelter costs continue to decelerate, although they remain elevated. As long as that continues, I think the Bank of Canada will feel like they can continue to give support. So really, I mean, the obvious, but the inflation and jobs data are really going to be paramount.